Howdy, Jacob here. Today we're looking at Trex. It is in the building industry, 10.5 billion market cap and enterprise value, nearly identical. Huge returns on invested capital. Historically, we're seeing as high as 50%, averaging in the high 20s, low 30s. Very impressive. Light growth in the last 2 years, actually negative. However, prior to that, there was very substantial growth. It looked like they may have grown a little bit too much post COVID with everyone trying to buy a house and everything. They're trying to where they're normalizing right now. But I don't know if they can get back to this growth, but I do think that growth will come back. Margins are very substantial, 25% on the operating side, 40% on the gross margin side. Very impressive there. So let's see that balance sheet. What does that look like? 2 million cash on hand, 6 million short-term debt, no long-term debt. Okay, I always feel more comfortable with a little bit of cash on hand. It's the same with being a person. It's not necessarily financially the best thing that you could do with your money, but there's something that comes with ease of just knowing. It's the same, when you could invest 99.9% of your cash into, or 99.9% of your wealth into investments and have just 0.1%. Like statistically, that's the greatest way for you to grow as large as possible. But there's something that comes with ease of having 5 to 10% of your worth in cash, or however, if you're worth a crazy amount, maybe not, but a couple $1,000s in cash is always just there to make you comfortable for those nightmare scenarios, those big cat claims that you just wouldn't understand, that you wouldn't necessarily expect. So a company like this, they might not, something big hits like 08, 09, they'll be able to survive with liquidity, and like with just $2 million. I'm a little bit skeptical, but I presume this company makes cash. So let's see. Okay, good free cash flow. Jeez, I don't know why I'm so difficult, but they are getting very high capital expenditures, much higher than they were prior. So free cash flow is absolutely higher than it was 10 years ago, but the fact that their capital expenditures have been as great as they are is a little concerning. Not concerning, I don't want to say that's the word, but a little bit on the negative side of what we could be seeing here. And it looks like in 2022 they bought back an immense amount of shares. I mean, it depends in 2022 when they bought that. If it was over here when it was 40, then they look super smart because it's over doubled. But if it were at the beginning of 22 when it was, essentially where it is right now, that might not have been the best price to buy back shares, especially when it's currently at a 50 PE right now. But let's use of cash. I like going over. So outside of that one huge year of share repurchases, they've actually not done too many share repurchases. I would say that on a 5 year average basis of both free cash flow and share repurchases, you're maybe looking at, if you take away this 398, you're maybe looking at 50%, 40%. And then this dividend is very huge. That's 100% right there of their most recent years. So that, oh wait, that was debt pay down. Okay, my bad. I saw D and that's not dividend, but okay, debt pay down 216. Okay, that's fine. No concern there. Um, I mean, I probably would have preferred that they had liquidity, but for all I know, that was 216. Yep. Okay. So 216 in short term. To me, I mean, maybe that would have been made a lot of sense to just refinance it, have a good amount of cash on hand to be able to do not a large amount of cash on hand, but just enough to where you're not concerning. To me, $2 million cash on hand for a company with 933 million in assets that incurs costs of 800 million a year, I would want more cash on hand. So that's just personal preference. I'm not saying that that's the best thing that the company should be doing to maximize earnings, maximize profits, but there's something that comes with just having ease and just being able to know that those large unknown costs would be covered without going into debt. So let's start making some assumptions here. I think they'll get back to some growth. I think the last 2 years are probably pretty fluke just because of the fact that they grew so much so fast. I think that probably wouldn't be surprised with maybe 4% growth. Very large return on invested capital, not 26. Whoa. 15 P in price free cash flow, I think relatively in line with the market due to the fact that growth really isn't there and they're not necessarily reinvest, or I'm not seeing them really reinvest back into themselves. They're just buying back shares and paying down debt. So if this company were to be reinvesting back in themselves, which I mean, we do see them increase their capital expenditures. I just wonder if there was maybe a shift to where acquisitions became part of property, plant, and equipment, because in sometimes some cash flow statements show acquisitions a part of here. So I don't know if maybe there's a shift there. I'm kind of assuming that, since if they were to be reinvesting back in themselves, you could absolutely see that here. And then with their historical rates of return being as high as they are, I would say that that's great money reinvested. But I'm presuming that that increase in capital expenditure is really just acquisitions. And so to me, I'm fine with all these figures. I do not like, though, that their free cash flow margin is so much lower than their earnings historically. I do like that last year it was greater, but historically it really hasn't been the case. So um, if we're looking at averages there, I'll probably trim the net income margin a little bit, bump the free cash flow margin a little bit. Share change. What is the market cap? 10 billion. So 1% would be about 100 million. Yeah, 100 million repurchase. That, I think that's pretty reasonable. And oh my gosh, this looks way expensive to me at the moment. I'm just not seeing. I mean, it's so expensive. I don't even know if I could reasonably get it to a price that would make sense. I mean, let's put that to the side. Let's say that they get back to these double-digit growth numbers. Let's say they grow 10% a year for the next 7 years. Maybe you deserve, you think, a 20 PE. Their margins are 20%. I mean, even at a 10% rate return, yeah, I can't. This is a company that looks just too expensive for me right now. I don't know if I'm missing something, but to me, return on invested capital, great. Increased operating margin, great. Increased gross margin, fantastic. Very safe balance sheet from not having a lot of debt. Or let me back that up. A safe balance sheet with as little debt as they have. But I am concerned about that 2 million cash on hand, cash equivalent. I'm a little bit concerned that they're um, they just pay down this debt to get to that $2 million. I think the logical thing would have maybe been to refinance. But I mean, I guess you could argue with me and say, well, why would 200 million in debt with 202 million in cash seems pretty similar situation. But to me, the duration that you could pay it out, and especially a company making good profit, it just to me is less concerning. But I can understand your perspective if you would say like it seems the same to you. But to me, if it can be paid out over the next 5-7 years or something, then yeah, if you do have a very positive earnings year, you can use your cash flow from operations to do it, but not necessarily your cash on hand. So that's just my perspective right now. Just super expensive. I wouldn't be touching this anytime soon unless it dropped like crazy. But yeah, hopefully you enjoy the video a little bit. Have a great rest of your day. Thank you.